Bob, good to see you again. Thanks for joining us.
Yeah, thanks for having me again. I'm looking forward to the day where I can actually be back there on the set.
It'll happen soon. We had Cisco's Chuck Robbins here today, so the invitation's always there. Talk to me about where you think guidance is headed, whether or not earnings estimates are truly behind the curve, and after we've done a lot of wood chopping on evaluation, whether the E is now suspect.
Yeah. Well, it's been an interesting year for sure. I mean, you've had the NASDAQ down almost 30% from the highs and S&P 18, 19% as well. What I think is interesting is when you look at the component of that with the S&P, with FANG or the top 7 stocks having such a heavy weighting, they're down over 30%, right? So that's really weighing just on the indices. And therefore, the remaining stocks are only down 12, 14%. So what's driving that right now? By far and away, number one has been multiple, right? So you've really seen valuations come back down here. In tech, for example, you had EV to revenue multiples, north of double digits, somewhere around 12, 14 times revenues, right? You've now seen that pull down to sort of mid-single digits or so. And even some of the sub-examples with software being much higher than that, close to 20 times revenues, coming down to double digits, and fintech even higher, right? So you've really seen some contraction in the multiples. But to your point on the question of estimates, yeah, so you saw over 3/4 of Q1 reports come in and revenues and earnings were beaten. The problem was there was a 2-to-1 taking down of guidance, particularly on the EPS side of things, as companies struggled with supply chains, inflation, war impacts. And I think that's right now what's leaving the question is what is the true E going forward? You see the S&P at an 18 times PE, and investors are trying to wonder, okay, but how solid is that E going forward? And could the PE actually be a little bit higher?
Right. I wonder, you list out there have been a number of concerns about inflation, volatility, China, Russia. I mean, it seems like there's a long runway between where we are right now and the period in which clients come to you with cash and are interested in bolt-on M&A, for example, in the internet space. Does that feel like it's a ways off?
Yeah, M&A is tremendous. So as you know, we're coming off of the record year of all time with $6 trillion of M&A done globally last year. As you look at us this year, year to date, so just sort of through April, we're down about 20% from last year. But last year's was all-time records. In fact, if you actually look at us year to date versus the prior 10, 15 years, we're on track to number 3, number 4 sort of top years. So M&A looks like it should be very strong this year. And it's partially driven by the valuations coming down, as we spoke about. It's also partially driven by the amount of cash. So if you just look at the sponsors, the private equity players, they have over $800 billion of cash just waiting to be put to use. And even if you look at the SPACs, they have over $600 billion of capital trying to be put to use. So you're talking about $1.5 trillion or so of cash on the sidelines looking to take advantage of some of the fallen prices and multiples here in the market.
Hey, Bob, it's John. Good to see you again. So maybe put the tech landscape in the context of some of the news that we've seen this week out of the likes of Walmart and Target, who are big technology customers. The promise of the digital investments that they've been making, these logistics investments over the past few years, is that they're going to both expand the customer base and drive loyalty, right? Which seems to me like why they're eating some of these costs now and not raising prices. But we're about to find out, aren't we, in this inflationary and possibly recessionary environment, which technology is actually worth it for them pursuing those aims? Because this would be the first recession of the smartphone and cloud era, right?
Absolutely. It's a really good point, a really great question. And I think when you think about just the offline names versus just the online names, you're really having that meeting in the middle. More of omnichannel is ultimately where all this is going. And I think I take it back to what Jeff Bezos used to say and his sort of mantra, what's most important, right? So price, selection, and convenience for that customer. How easy can you make the experience for them, whether it be purchasing the item, returning the item, and obviously being able to have a good price on a vast selection. So I think at the end of the day, what you're going to see is hybrid or omni-channel is ultimately the wave of the future. And whoever can handle the customer and be most customer obsessed is set for a good win.